Bonus lecture. Accounting terms you should know. In this lecture, we will mention some accounting terms related to project selection that you should be familiar with for the PMP exam. First term is opportunity cost. Opportunity cost is the cost of not to select other project. For example, consider there are two projects, Project A and Project B. Project A has MPV of $80,000 and Project B has MPV of $50,000. If you choose Project A, what is the opportunity cost? Well, you don't need to make any calculation. Since opportunity cost is the cost of the other project, which is not selected, then the answer is $50,000. Sunk costs. Sunk cost is the money that cannot be recovered. For example, you will decide whether to continue or not to continue to Project A. Actual cost spent up to now is $100,000. Therefore, sunk cost is $100,000. You need to know three things about sunk costs. Sunk cost is gone and cannot be recovered. Because it is sunk, it is history, it is gone. Sunk cost is the actual cost spent up to now. You don't need to make any calculations. Do not consider sunk cost when you make calculations in order to decide whether to continue or not to continue to the project. For example, if you spent $100,000 up to now and you need to decide whether to continue or not to continue to a project, do not consider this $100,000 while making your decision. Just remember this. Never look back. Economic value added. Please note that economic value added is abbreviated as EVA. All you need to know about EVA for the exam is it is nothing but the profit of the project to company. That's it. Law of diminishing returns. In order to explain this term, let's give an example. One painter paints a room in 4 days. Two painters may paint the same room in 2 days since you double up the number of painters. But what if 4 painters try to paint the same room? You may think that since you double up the number of painters, it will take 1 day, which is half of 2 days, to paint the same room. But since you increase the number of painters in the same room, the room will be so crowded. This may cause some coordination problems. Therefore, it will take more than 1 day. Let's say it will take 1.5 days for 4 painters to paint the same room. After a certain point, increasing the amount of inputs will not increase the productivity in same proportion. This is called law of diminishing returns. Working capital. Working capital is the amount of money that your company can spend to invest. Or you can say it is the money that your company is available to invest. Depreciation. In order to understand this term, let's give an example. You bought a computer this year. After 2 years, if you try to sell it, you may sell it half the price you bought today. Your computer lost half of its value in 2 years. In accounting terms, this is called depreciation. There are two depreciation types. First one is straight line depreciation. You paid $600 for your computer today. You try to sell it next year and the sale price is $450. But you decide not to sell it. You wait for the second year and the price you sell is decreased to $300. Therefore, the computer lost same value, $150 each year. This is an example of straight line depreciation. Second type of depreciation is accelerated depreciation. You paid $600 for your computer today. You try to sell it next year and the sale price is $450. But you decide not to sell it. You wait for the second year and the price you sell is decreased to $100. Therefore, the computer lost its value more than the previous case in straight line depreciation. This is an example of accelerated depreciation. This is the end of the bonus lecture named Accounting Terms You Should Know.